inflation or stagflation? That is the question. At least that's the one I'm posing right now, right? We all know that inflation is the general rise in all prices in the economy, right? And normally, rising prices are associated with low unemployment and growth. That's a healthy economy. Rising prices associated with slow growth and oftentimes high unemployment is an unhealthy economy. And now we have rising prices associated with volatile growth and low unemployment. So this stuff is really kind of complicated. I think in the end, I would like to ensure that everyone here starts thinking about the difference between nominal interest rates and real interest rates. And so the Fed is responsible for affecting interest rates, real interest rates, not nominal interest rates, right? And so they do that through their monetary policy. Stagflation has occurred in our history. And because I'm not going to go through all of our slides, in part because of lunch, I thought this was a pointer. Maybe that's the pointer. Good deal. All right. So here's a little history lesson. 1960, 69. Sorry, guys, right there, right? Many of us, some of us, remember the time when we had stagflation in the 70s, right? How dissimilar is that environment to the one we're in now, right? We had kind of slower growth. I think we also had an oil embargo, right? OPEC limited our oil supply. We had an energy crisis along with some slow growth. We had a Federal Reserve Chairman Burns who got the policy wrong, caused interest rates to go up several times during the 70s, only to take them down, right? And so that combined with Nixon's policies, fiscal policies combined with monetary policies. So Nixon put on price controls, right? Took us off the gold standard. All kinds of mess was going on. We were sitting in gasoline lines. Now, I just want to make a comment here. This graph, or in addition to being the history lesson, this graph in the yellow line is the prices for core services. So remember, inflation measures goods and services. And I'm separating out the prices for goods down here and the prices for services in yellow. And each one of these little red marks is a recession that has occurred, right? Now, recessions are good. Mini recessions are good. And it's my expectation that we will have some mini recessions. Economic growth is very volatile right now. 3 quarters ago, up 2.1%. 2 quarters ago, up 6.9%. Then the most recent print, up 1.2. That's pretty darn volatile for GDP, right? So we're in kind of a quandary right here. But back to the goods and services. So let's just, so we now know then that after Burns resigned, Nixon's finished with his tenure, and then Volcker comes in, right up here. Okay, the core service prices are above 15%. The inflation rate for services was above 15%. Who can guess what the Fed funds rate was at that time? 14%, right? Can even any of us imagine that? And so right here, what happens? Volcker comes in, what does he do? He surprises us with a 200 basis point increase, just like that. 200 basis points. We're concerned about going from 25 to 50. Volcker comes in and does that. What happens? I would say that's called a really hefty recession right here in the 80s, right? It was a very difficult time. So we now have a recession. Now, mini recessions are good. Big recessions, not so good. They're much more painful. But mini recessions are the way we're going to get out of this price inflation that we're having. So now we're finished with all of this, basically in the 80s. And then after the 2001 kind of market crisis right here, the tech bust, We had a little recession, and basically we have had zero or very low Fed funds rate, up maybe 2% max, right, during that time period. Very easy money, right? Look at this, print. CPI core is up 14, or at least approximately 13%. The prices for goods is up by 13%. It's huge. The prices for services up 4+. What a dispersion, right? So what's going to cause this to be more normalized, right? Prices for goods are up that high in part because the demand for goods was up that and is up that high. I was telling someone recently I didn't travel during 2000 and 2020 and 21 very much, but I did buy a really nice mattress. People bought goods. People bought televisions, people bought cars, people didn't go to restaurants, and they didn't go to hotels. So more normalization is expected as we get through COVID, but it's just not going to drop, right? Because demand isn't going to just drop. So a little bit of history here, because many of us, especially those of us who don't color our hair and have natural brown hair, have never really seen this before. But this can happen again, right? So our current fiscal policy has been very accommodative, in part because of COVID, right? And there is a lot of money in the system, a lot of savings in accounts that hasn't been spent yet that will be spent, okay? So we have tremendous supply and demand issues to deal with, where oftentimes we may just have demand issues to deal with, right? So it's a tough problem. What I can say, though, is what I think of our current chairman. I knew Volcker, but I really was very young. I really didn't understand his policies and where he came from. I read a lot of his academic papers, so I kind of understood what he was all about. But this current chairman is measured and transparent, and that's a good thing for all of us, right? To the extent that he and his colleagues decide to go up 50 basis points, remember, it's not the 200 basis points, but a 50 basis point increase in Fed funds rate is going to be a shock to our system unless we completely expect it. And even if we expect it, it's still going to be a shock. So then what happens? What happens when Fed funds rate goes up 50 basis points? What does that do to the demand for goods? The demand for services, right? So this idea, I came up with it last night, quite honestly, this idea, I think that the Fed would be good to serve us well if it caused little mini strokes in the economy instead of a massive heart attack or a massive stroke, right? Let's take it bit by bit, because we're going to have some work to do to normalize this economy that we're in. Forgive me for putting up a graph, but I think it's, at least at some time, I thought it was important to kind of look at, so we talk about GDP and economic growth as if it's just this thing that we report on. But it's the aggregate demand for goods and services in the economy. It's everything we buy as consumers, everything investors do, right? Everything the government spends, GDP equals C plus I plus G plus net exports, right? And all of this is kind of in turmoil. Think about the net export component to GDP. And the reason I'm saying this is because that's what the aggregate demand line is. It's the demand for goods and services. It's effectively measuring GDP. Now, there is no such curve out there in the real world, but this is the way you look at it, right? So simply, and then we have the supply of goods and services as aggregate supply. So where these two meet, aggregate supply at time zero and aggregate demand at time zero, at that intersection, you have an output or GDP there at some kind of general level of prices. Okay? Easy peasy. Complicate things. Aggregate supply is impeded. The supply for our goods and services has shrunk. The supply for energy has shrunk. The supply for food has shrunk, which causes the aggregate supply to come back, shift backward and inward. Where is the intersection between the demand and the supply now? It is at a lower level of growth and a higher level of price. So it's not rocket science, it's that easy. So we've had a supply side shock that has caused prices to go up. Well, lots of ways we can get out of the supply side shock. Let's see if I do that, and a little red line occurs. So this idea that if demand increases for goods and services, this is a beautiful thing because I can easily then come up back to output or GDP at a 2 or 3% growth rate, right? But if demand doesn't increase, then I'm going to have persistently high prices at a lower growth rate. That's stagflation. How bad is it going to be? Probably not as bad as the 70s, but that's what it is. It's that simple, right? So now, if aggregate, if aggregate demand, well, you got the point, right? So if we have aggregate demand increase after the supply side shock, we're going to get back to regular growth and lower prices, but otherwise we're not, unless other things happen, right? So very complicated stuff, except it's that simple in theory. My little alarm is going off. I was asked to not get in between you and lunch, so I'm going to skip this slide. Oh, except, just quickly to say, if I can, there we go, that I think it's really important we recognize that there is, in effect, a kind of a regime change in our economy, right? We had stuff going on where this is the 30-year Treasury in the green line, and regular CPI inflation. We just looked at CPI inflation, but we separated it out for goods and services. Now we've just taken the general headline CPI inflation, and you can see that the 30-year and CPI, while not perfect, and you can point out the times when we had our recessions because CPI drops, right? So a little mini recession might cause CPI and prices to drop because demand drops, and that's that mini stroke I'm talking about, right? So here we've got all that kind of happening on its own. Yeah, policymakers are mucking it up at times, sometimes getting it right. But then we have this completely different regime between CPI and the 30-year bond. This is not a particularly special relationship, CPI and the 30-year bond. But I thought it was interesting that after the 2001 tech bust and totally easy money, right, that relationship is distinct and different. And just give me 3 more minutes, or 5 maybe. Those periods of time when the yield curve gets flat, so this relationship, so what we're looking at is that 30-year bond again, and now we're looking at Fed funds. So I know many people measure the yield curve structure between 2 and 10, or 3 months and 30. Doesn't much matter to me as an economist. It all means the same thing. What's the spread between long and short rates? And why does it matter? So these, very quickly, are periods of time when long and short rates get really close and start kissing each other, right? Or on top of each other. And that's what you call the yield curve flattening. And we all know that's supposed to mean that the economy is slowing. Well, what's really happening? If the yield curve is flat, banks can't make any money, right? Because they lend out short, right? And wait, they borrow short and they lend out long, and so they have to have a spread in that yield curve to make a net interest margin. If banks aren't willing to be active and out there, well, that's going to slow down the economy. So again, really complicated, lots of stuff going on. But it's also the case for those of us in here who are looking at our equities, to remember that when the yield curve gets flat, it's usually just before that we have slightly negative equity markets, okay? So again, we like the mini strokes. We like the slightly negative equity markets if it means that we're not going to go through 2008 again as far as equities go, right? So this is just another example of the term structure of interest rates, how we have completely changed. The blue line is a year ago. The yellow line is the term structure of interest rates. Again, we could have a whole class on that, right? But look at where we are. The 2 to the 30 is effectively flat. All right, lots to say about how that's going to unwind itself, how long it'll take to unwind. It's not going to be an easy process. We are going to feel some pain. I know that you heard earlier of someone talking about where you would go at an asset allocation, or what kind of PEs you should be buying, value over growth. Have cash on hand to pay your liabilities. That's what I say, right? Because we don't know the future, no one does. The Fed doesn't even know how many times it's going to cause the short end to keep going up, right? That long end better get steep, and there are ways to do that. And the Fed has policies to do that, and hopefully they work, but they may not. And so flat yield curves are generally not great yield. Economic environments and companies usually have a struggle, especially through the banking mechanism. So I promise to be brief. My alarm's been ringing for 5 minutes on my wrist, but I would welcome a question or two for those of you who don't want to run downstairs and get your lunch. Any questions? Yes.
So wearing a investment manager hat or a trustee in place can't stop investment and how would you advise investors, broadly speaking, as we move into a period where the system is working to pressure and bring many stroke issues?
Yeah. Thank you for the question. I will briefly try to reiterate it. Now what do you do? As a long-term pension fund investor, where do you put those new contributions that are coming in? Do you follow that asset allocation, or do you go outside of that, or what do you do? Well, the first thing I would do is I would look at your policy asset allocation and have a really thoughtful discussion with your consultant about how much you can keep in which asset classes. And the second thing I would do is I would be very seriously considering learning how to use this mechanism I'm holding right now. But I would seriously consider buying a 2-year treasury and parking it and getting 2.25%. For years, we've been wishing we could get 2.25. I know inflation's 8. We can't do anything about that. So I would become slightly defensive with my new contributions. I would make sure I didn't have to sell in an otherwise stressed out equity market. Again, we don't know the future. Equities might soar, and I could be completely wrong, but I don't mind being safe. And right now, I think it's reasonable to stay short on, especially match your short-term liabilities with some short-term cash and get 2.5% on them. You can go and buy a corporate and get some spread here too. Right? There's no need to go out any farther on that curve, right? So that's what I would do, and I don't object either to the value over the growth trade. I think that's a reasonable trade. And those are two simple things, but make sure your policy allocation allows you to get defensive in your cash bucket and your bond bucket. We all know, and it's just the last slide, this idea that we all have these expected returns, these capital market assumptions. And if I've got expected returns looking like this, which is what most of the consultants, this is just a composition of maybe 10 or 15 big consulting firms that came out with expected returns. This isn't fancy stuff. So I've got a median return of 5.30 on equities. I got a 5% inflation. My real return on equities is effectively 0, if that's the case. Right? And now we've got, whoa, this going on in the bond side, right? So many of us are already moving away from the bonds. So be really careful with your bond portfolio. Make sure your duration, this is not unlike what other people have said, but there's truly an opportunity, a risk-return opportunity in that 2-year, 3-year bucket. Go ahead and get yourself a couple basis points in yield, 200, almost 300 after the Fed moves again. And then just be okay and ride this one out. Thank you for your question. Thank you. Oh, one more.
What do you think about I bonds?
Inflation-adjusted bonds. I generally like them. I generally like them. And so that's a great idea. Go ahead and buy an I bond out on the curve a little. Remember, buying a 2-year, you're exposing yourself to some opportunity costs, right? What happens when that matures and rates are really low? So to the extent that you're an I bond or inflation-adjusted bond buyer, like you like that stuff, I like that stuff, then go ahead and you can go out on the yield curve and protect yourself a little more with an I bond. Make sure you understand how that coupon adjusts. Marvelous. Thank you for everything you do.